So let us start first with the revision of time value of money. So we have understood time value of money in this manner. That is, value of money today is greater than value of money tomorrow. So please understand, if I give you rupees 100 note today, the real value of it is more than if I give you rupees 100 note tomorrow. The value changes slightly, but this value will be more than this value. Sir, both are 100 rupee note. That is a nominal value. Nominal value today and tomorrow is same, but the real value is always today. So I have told you, if you are going to receive money, receive as soon as possible. And if you are going to pay money, pay as late as possible. This is concept of time value of money. Value of money today is more than value of money tomorrow. Now, to find out what is the equivalent value in future or what is the equivalent value today, we have understood some of the mathematical questions of time value of money first in 6 portions. Future value questions and present value questions, or compounding and discounting questions. We have categorized it into 6 parts. First category of question, present value is 100, rate of interest is 10%. What will be amount after 5 years? How to find out the answer? It is A is equal to P into 1 plus I raised to N. Basic formula that we have learned. 100 into 1.10 raised to 5. Answer will be 1.1 multiplied by is equal to, this is raised to 2, 3, 4, 5 multiplied by 100. It is 161.05. Second category of questions, same to find out future value, but they are in different installment. At the end of first, second and third year, rate of interest is 10% if the amount is 100, 200. Find out amount at the end of third year. How you will find out? Into 1.10 raised to 2 into 1.10 raised to 3. Why 2? If you invest something at the end of first year, withdraw at the end of third year, you will be getting second and third year's interest. That is 2 years interest. And in this case, I will be getting only 1 year interest. So this will be 220. This will be 1.1 into is equal to multiplied by 100. 121. You can even do it with M plus. These are second category of questions. Third category of questions goes like this. The rate of interest is 10% and the amount invested at the end of first, second and third year are equal. So they are termed as annuity questions. What is amount after fourth year? How to find out? 1.10 raised to 3, 1.10 raised to 2, 1.10 raised to 1. What we do? We take 100 common and this portion we add it into memory. How to add it? 1.1 M plus multiplied by is equal to, this is square. M plus is equal to M plus. MRC is 3.641 multiplied by 100. I get answer of 364.1. Category number 3 questions. Category number 4 questions. Simple question of present value. Amount after 2 years is say 4,000. Rate of interest is 10%. What is present value? How to find out present value? Is A into 1 divided by 1 plus I raised to n. Here 4000 into 1 divided by 1.10 raised to, how to find out answer in calculator? 1 divided by 1.1 is equal to multiplied by 4000, 3305. Fifth type of question, same, to find out present value, but the amounts are different. Say rate of interest is 10%. What is present value? See, don't get confused in this and this question. Here you need to find out future value. Here you need to find out present value. This will be 1 divided by 1.10 raised to 1. This is 1 divided by 1.10 raised to 2. How to find out this answer? You can do m plus 1 divided by 1.1 is equal to multiplied by 100 is equal to m plus 1 divided by 1.1 is equal to multiplied by 200 is equal to m plus MRC is your answer, which is 256.19. And last, sixth type of question. It is present value annuity at the end of first, second and third year. Say the amount is 100, 100, 100. Rate of interest is 10%. What is the present value? I want to find out present value. It is different from this question. It is 1 divided by 1.10 raised to 1, 1 divided by 1.10 raised to 2, 1 divided by 1.10 raised to 3. I'll take 100 common, add the remaining portion in my memory. You can do it with GT. 1 divided by 1.10 is equal to GT multiplied by 100. I'm doing it with m plus 1 divided by 1.1 is equal to m plus is equal to m plus is equal to m plus MRC multiplied by 300, no 100, because we have taken 100 common, 248.60. is present value. How to do it with GT? 1 divided by 1.10 is equal to GT multiplied by 100. You will be getting answer of 248.68. These are 6 category of questions. Seventh one, present value of infinite cash flow, which is annuity. Suppose at the end of first, second, third up till annuity, cash flows are 200, 200, 200 up till annuity. If someone tells you to find out present value of this cash flow, present value of infinite cash flow with annuity can be found out by amount of first year divided by rate of interest. What is my required rate of return? Say 10%. So rate of interest is 10%. My answer will be 200 divided by 10%, which is 2000 rupees. And eighth category of question are present value of infinite cash flow with growth. Say at the end of first, second, third year up till infinite, the cash flow is 100, 105, 110.25, which is increasing at a growth rate of 5%. If required rate of return is 10%, let me take a different figure, 12%. How to find out present value of all this cash flow which are growing at 5%? Present value of infinite cash flow with growth will be is equal to amount of first year divided by rate of interest. This formula remains same. Here you just need to do minus G. So amount of first year is 100. Rate of interest is 12% minus G is 5%, which will be 100 divided by 7%. You can directly do it in your calculator. 100 divided by 7%. 1428.57. These are 8 categories of sum which should be at the tip of your calculator. If anyone gives any of the question, you should be very much perfect with this all 8 category of questions. What is the reason? Try to understand. Before that, let us summarize all the formulas that we have done up till now. We have done A, P into 1 plus I raised to n. When the interest is compounded more than 1 times, P 1 plus I upon K, n multiplied by K. If you want to find out real rate of interest, it is 1 plus I upon K raised to K minus 1. Of course, if you want answer in percentage, you will have to multiply it by 100. And last one, present value is A into 1 divided by 1 plus I raised to n. So these are the basic formulas that we have learned in the concept of time value of money. Why we are learning time value of money, or why time value of money is important? Let me take one question. Say this, amount after 2 years is 4,000. The present value for the same is 3,305. Please understand, at 10% rate of return, value of 4,000 after 2 years is the same as 3,305 today. So what you can purchase at 3,305 rupees today, you will be able to purchase the same thing at 4,000 rupees after 2 years. The value, real value of all this money is same. So if you give me 3,305 rupees today, I will be getting same value if you give 4,000 rupees after 2 years. This is the concept. There should be a conceptual clarity in all the cases. Let us go to valuation in finance. We have done it in previous lecture. We are going to solve some of the questions even over here. We know valuation in accountancy is done at cost. How accountancy is important is only recording purpose. Finance is a decision making subject. And how to value anything in finance. I'm not talking about company shares, pen, machinery. I'm talking about anything in finance. Whether tangible, intangible, current, fixed, anything in finance is valued by one concept, which is present value of future cash flows. So if you get cash flow of some asset, if you are having your own discounted rate of return, you can just find out present value and get valuation in finance. To value a pin, to aeroplane, to a company, to a country, same concept is used. It is finding out present value of future cash flow. What cash flow that asset will be earning, just find out present value at your required rate of return. You will be getting your valuation for finance. Let us start some of the questions. For valuation in finance. What is valuation? Present value of future cash flow. That will be applying in some of the questions. Tata shares is expected to declare dividend of ₹5 at the end of the year. So at the end of first year, Tata is going to declare ₹5 as dividend, which will be our cash flow. Mr. X is having 10% required rate of return. So required rate of return is a 10%. Shares are expected to be sold at 105 at the end of first year. So what does it mean? This person is planning to purchase share today. He will be getting first year dividend and immediately he will be selling the shares at the end of first year itself. So he will be getting 105 rupees more. Total he will be getting 110 rupees. Now what will be the cash flow after second year? 0 rupees. Because if we sell the shares in second year, we will not be getting any dividend. So our cash flow will be only for 1 year. Now you will say, sir, this is capital gain and we need to think only about one thing, that is cash flow. If I purchase one share today and if I am going to sell after 1 year, I will be getting cash flow of first year's dividend and the selling price which I am going to get, which is 105 in this case. What is the maximum price Mr. X is ready to pay for the share? So they are asking valuation of the share for Mr. X. How Mr. X will value his share? Present value of future cash flow. What is future cash flow for Mr. X? 110 multiplied by 1.10 raised to 1, because this is cash flow of first year. What will be the answer? Is rupees 100. Sir, rupees 100 is a market price of the share? No. This is valuation for Mr. X. Mr. X feels that the share should be of rupees 100. Remember that example of jeans. By touching the jeans, by seeing the company, I feel that the jeans is of 2000, 3000 rupees, 2000 rupees. And if the jeans is available in the market at 5000, now that is a market price. But by touching the jeans and seeing the company, I think that the jeans is worth rupees 2000. Then that 2000 is theirs. It is my valuation for finance. It is Mr. X valuation for finance. Also, it is maximum price Mr. X is ready to pay. Why only Mr. X? Because we have taken discount rate of Mr. X, right? So the question can be framed in both the manner. What is the value of the share? What is the valuation as per finance? What is the maximum price X is ready to pay? The concept is same, which is rupees 100. How to find out rupees 100? Present value of future cash flows. Here the cash flow is only of 1 year. We will be finding out present value of only 1 year. I am getting rupees 100. What is the maximum price X is ready to pay for the share? Is rupees 100. Whether to purchase or sell the share at 1 rupees 100 current market price, or option number 2 rupees 120 current market price, or option number 3 rupees 100 current market price. So there are 3 options available. Option number 1, if market price of share is rupees 80. Option number 2, market price of share is rupees 120, or option number 3, market price of share is rupees 100. So I will need one volunteer. First answer will give me market price of share is rupees 80. Then what is this? 100 rupees. And whether you will purchase, sell, or remain constant. Yes, Kushali, tell me. Kushali, tell me. It is undervalued by market. What we say it in Hindi? Market में सस्ता मिल रहा है. Then what you will do, Kushali? Okay, what Mr. X will do? He will purchase or buy this share. Now please understand, this is the second option. Then Kushali, what is rupees 100? This is not market price.
No, sir, it is the expectation of Mr. X.
Exactly, it is expected value for Mr. X. It should be the price of the share. Good. Let me do this on my own. If market price of the share is 120, which is the option, market has overvalued. Market has overvalued. In Hindi, market में महंगा मिल रहा है. If market has overvalued, you will sell the shares. Please understand, these are the different options of the same share. If market price is rupees 100, market has exactly valued. As per you, the price should be 100. As per market also price is 100, you will hold. Or you are indifferent. You may purchase, you may sell, you may hold. It does not make any difference. So this is the case for all three scenarios. See what you are doing in finance. Yes, you have valued something as per finance, but ultimately you are making decision whether you will purchase, whether you will sell, or whether you will hold the shares. Let us go to second one, where we are not talking about shares. A machinery is expected to generate 10 crore cash flow every year for the period of 10 years. So if you purchase the machinery, what will be your cash flow at the end of 1, 2, 3, 4, 5, 6, 7, 8, 9 and 10? Every year the cash flows will be 10 crore rupees. Rupees are in crores. After 10 years, the scrap value is 0. So the machinery will not yield any scrap value. So if you purchase the machine, see, you will have to think in this manner. If you purchase the machinery, what will be cash flows in future? Cash flow will be rupees 10 in future. Every year for the period of 10 years. 11th year, no cash flow, because the machine is scrapped and no scrap value is realized. If required rate of return is 12% for XYZ Limited. So we are talking from the point of view of XYZ Limited. Advise the company, should it purchase the machinery at 97 crores or not? How? First we will be finding out our valuation. Our means XYZ's valuation. What will be the valuation? Present value of future cash flow. What is present value of future cash flow? I'll just find out present value. 1 divided by 1.12 raised to 1. This will be 1 divided by 1.12 raised to 2. So on. This will be 1 divided by 1.12 raised to 10. What should be done? I will be taking 10 common. I will be adding everything in my memory. If you are having calculator, you can use GT. How to do it? 1 divided by 1.12 is equal to 10 times GT multiplied by 10. You will be getting answer for that particular point. I am not having GT, I am having M plus, so I am doing it by M plus. 1 divided by 1.12 is equal to M plus. This is first, second, third, fourth, fifth, sixth, seventh, eighth, ninth, 10th year. MRC multiplied by 10 is equal to 56.50 crores. Is the maximum price XYZ Limited is ready to pay. Then what is market price of machinery? It is 97 crores. Should you purchase this machinery or not? The answer is no. Market has overvalued. Market में महंगा मिल रहा है. Will you purchase? I will not purchase. Believe me, this is the question of capital budgeting where we have found out NPV. But right now, just understand the concept of valuation in finance. That is a present value of future cash flow. Advise the company, should it purchase the machinery at 97 crores or not? We have advised the company should not purchase. Company should maximum pay 56.5 crore rupees for this machinery. At 97 crore, the company should not purchase this machinery. Say if you are in accounts, let me go into accounts. The decision is somewhat weird. In accounts, you never find out present value. So what cash flow you are earning? 100 crore. What is the cost for machinery? 97 crore. So what will be profits for 10 years? In 10 years, you will be earning profit of 3 crore rupees. Now you will say, sir, it is not bad. 3 crore rupees is a big sum of money. But try to understand, if you will do something by finance, it will automatically consider your opportunity cost. See, by investing 100 crore rupee, you are earning 3 crore rupee in 10 years. Which is good or not good? Not good. It is 3% rate of return for 10 years. In 10 years, you are only earning 3% rate of return. This account cannot consider. Finance has automatically considered opportunity cost in this required rate of return. I will purchase the machinery only if it is giving me minimum 12% required rate of return. So the concept of opportunity cost in first lecture, I have told you it is some base of finance. Finance will always consider opportunity cost. In this case, in this particular case, that is 12% required rate of return. Believe me, machinery will not be purchased if it is not giving us 12% rate of return per annum. This project is giving me accounting rate of return 3% over 10 years. So in 10 years, we are getting 3% accounting rate of return. This was second one. Again, a good question. All right. A Limited is expected to generate rupees 10 dividend per share every year. All right. So at the end of 1, 2, every year 10 rupees will be generated. For how many years it is not given. So we are assuming we are promoter of the company, owner of the company, we are never going to sell the share. What is the maximum price he will be ready to pay for the share if expected rate of investor is 10%? What is the maximum price he is ready to pay? How to find out maximum price or valuation in finances? Present value of future cash flow. Can you find out present value of infinite cash flow, which is annuity? This is annuity because 10 rupees is dividend every year. Yes. How to find out? Amount of first year divided by rate of interest. Amount of first year is 10 rupees divided by rate of interest is 10%. So rupees 100. Maximum price I am ready to pay for this share is rupees 100. Advise whether the share should be purchased at rupees 98 market price or not. So if market price of share is rupees 98, market has undervalued and hence you should purchase A Limited shares. You need to compare this my valuation in finance with market valuation in finance. मार्केट में सस्ता मिल रहा है, I'll purchase it. मार्केट में महंगा मिल रहा है, I'll sell it or I'll not purchase it. Now, those are some good questions of valuation. You should always know this. It is asked 2 or 3 times in last 10 years. This type of question directly of valuation, even if valuation is not a specific chapter in your syllabus, it is a part of cost of capital. A Limited is expected to generate 10 rupees 10 dividend per share every year with a growth rate of 9% every year. if the expected rate of investor is 10%, what is the maximum price he is ready to pay for the share? Advise whether the share should be purchased at 960 rupees market price or not. So let us do it. At the end of first year, it is going to generate dividend of 10 with a growth rate of 9% every year up till infinite period of time. So 10.9, 9% will be, yes, 10.9. 10.9 will be cash flow for second year, and it will be growing at 9% every year. So growth rate is 9%. Can I find out present value of infinite cash flow with growth? Yes, it is amount of first year divided by rate of interest minus G. Amount for first year is 10. Rate of interest is 10% minus growth rate is 9%. So 10 divided by 1%. It is 10 divided by 1%, which is rupees 1000. What is the maximum price I am ready to pay for this share? Is rupees 1000. At rupees 960 market price, whether we should purchase the share or not. Rupees 960 is market price of the share. Market as undervalued, I will purchase the share. As per me, the share should be of 1000. Jeans should be of 2000. What is the market price of the share? 960. I will purchase it. What is the market price of jeans? 1000. I will purchase it. So whenever I get confused, I always remember the concept of jeans and I'll be getting a correct answer. Now this type of questions are important. It is asked, as I told you, couple of times in intermediate examination. Difficult Limited is expected to declare rupees 10, rupees 12 and rupees 14 dividend for first 3 years. End of first, second and third year, 10, 12 and 14. For first 3 years respectively. This should be written in the question. So 10 is for first year, 12 is for second year and 14 is for third year. Thereafter, company is expected to declare dividend of rupees 20 in fourth year. Let me change the color. And will remain constant throughout the lifetime of the company. So fifth year also 20, sixth year also 20 and so on. Find out valuation of company if the required rate of return or discount rate is 13%. How to find out value of the company? Present value of future cash flows. Please understand, I will be dividing this question into two parts. First is this easy part, black color part. It is 1 divided by 1.13 raised to 1, 1 divided by 1.13 raised to 2, 1 divided by 1.13 raised to 3. I will be getting this answer by simple use of calculator, and it will be value at the end of 0 year. Let me do it. It is 1 divided by 1.13 multiplied by 10 is equal to m plus 1 divided by 1.13 is equal to multiplied by 12 is equal to m plus 1 divided by 1.13 is equal to multiplied by 14 is equal to m plus. MRC is my answer, which is 27.95. What is difficult portion is this? Blue color part. This is infinite cash flow without growth. Agreed. But this cash flow is not starting from first year. It is starting from fourth year. And our formula says that cash flow amount should be of first year. See what is written? if you want to find out present value, that is, if you want to find out value as on today at the end of 0 year, and if you are having infinite cash flow without growth, that is infinite cash flow of annuity, it is amount after first year divided by rate of interest. Please understand, your amount is not at the end of first year. So sir, we will be taking amount at the end of fourth year. No, this cannot happen. So what to do? Try to understand. We'll have to play with the formula. If you want to find out answer as on today, you should start with first year. So I'm changing the formula. If I start with fourth year, I will not be getting at the end of 0 year, but I will be getting amount at the end of third year. If this is 1, this is 0, this will be 4, this will be 3. So amount after fourth year is 20 rupees. Divided by rate of interest is 13%. Now there is no growth rate. This is 20 divided by 13%, which is 153.84. Add it with this. No, in finance you cannot do this. This is amount at the end of third year and not at the end of 0 year. Why? We have started with amount at the end of fourth year. We have used the normal formula. The amount which we are getting will be at the end of third year. You cannot add it something which is as on today, which is at the end of 0 year. So this two cannot be added. So what to do? Very simple. If this amount is at the end of third year, convert it into amount at the end of 0 year. So discount it for 3 years. 1.13 raised to 3. Anything which is after third year, if you discount it for 3 years, you will be getting today's value. This will be today's value. And what is that value? It is 1 divided by 1.13 is equal to multiplied by 153.84, which is 106.61. Now these two values can be added. Yes. 27.95 is present value of this first 3 years, and fourth year onwards the present value is 106.61. What will be total present value? Will be 27.95. This is value for first, second and third year, and fourth year onwards the present value is 106.61, which is 134.56 rupees. This is the maximum price I am ready to pay for this particular company, which is difficult limited. This is excellent. You are not having a direct formula. You start with amount at the end of fourth year, use that infinite formula, you will be getting amount at the end of 3 years, again discount it for 3 years, you will be getting present value, and you can easily solve the question. Next is similar type of question. It is growth difficult limited. Let us change the name. Growth difficult limited is expected to declare rupees 10, 12 and 14 dividend for 3 years respectively. This remains same, 10, 12 and 14. Thereafter, the company is expected to declare dividend at the end of fourth year of rupees 20, after which company will be having growth in dividend of 6%. Find out valuation of company at 13% discount rate. So let us first solve this purple color. I want to find out P0 for this purple color. It is very easy because we have already found it, which is 27.95. It is answer of only this 3 years. Let us go to this. Now the concept is same. If I start with 4th year cash flow, I will be getting answer of 3rd year. So amount after 3 years is nothing but amount after 4th year upon rate of interest minus G. So let us find out this amount after 3 years. Amount after 4th year is 20, rate of interest is 13% and growth rate is 6%, which is 20 divided by 7%. Let me find out the answer. 20 divided by 7% is the 285.7. Let us add this 2. We cannot add it because this is amount after 3 years. Let us convert this amount at the end of 0 year. How I'll do it? 285.71. This is amount after 3 years. I will discount it for 3 years at 13% rate of interest. I will be getting amount at the end of 0 year. Or amount at the end of 0 year is nothing but principal. 1 divided by 1.13 is equal to multiplied by 285.71, 198.01. Can I add this two figure? The answer is yes. For first, second and third year, valuation or present value is 27.95. And for remaining 4th year onwards, the valuation is 198.01. The total valuation will be 27.95 plus 198.01, which is 225.96. 0.96. If you are concentrating, the valuation should be higher than this, because here there was no growth. Here there is a growth rate of 6%, and see how the valuation has increased. It has become 225.96 from the valuation of 134.56, because after 4th year there is a growth rate of 6%. The only difference is this between these two questions. Again, a good portion is this. If you are having amount at the end of 3rd year, first there is an infinite cash flow starting from 4th year. So let us convert that infinite cash flow into present value, which will be at the end of 3rd year. Then again discount it for 3 years, you will be getting current present value. This is how. This is the maximum price I will be ready to pay for this growth difficult limited. If the market price is 200, I'll purchase it. If the market price is 250, I'll not purchase it. And this is valuation in finance. We have done n numbers of questions which will become base for valuation of security, valuation of machinery, valuation of company, valuation of country. Any valuation, you should know how to find out present value. Once you know how to find out present value, you can value anything in finance. Yes, there will be point of how to find out required rate of return, how to take required rate of return. There will be point of how to find out cash flow. But once you are having rate of return cash flow, you can just use mathematics of finding out present value of future cash flow, and that will be valuation in finance. So this should be at tip of your tongue anytime you are doing finance. Present value of future cash flows is nothing but valuation in finance. It is also maximum price a person is ready to pay. Which person or which company, whose required rate of return you are taking. This will be all for today.